All right, we're recording. All right, good morning. Welcome. We're going to be here for 20 minutes and we're going to cover an awful lot of stuff. Obviously, yesterday was the big day with the crop report. So we're going to jump right into that, go through what it says, and try to put it in perspective, and then look at the charts real quick. All right, so first of all, for soybeans, this is straight out of the USDA report. This column here is what they think is their best guess for how last year's marketing year ended. And this is their first projection for what the new crop is going to look like. So for 2020, that marketing year begins at harvest and ends at the beginning of harvest the following year. So this is the number that we're now trading off of and looking at. So, and this is helpful because it keeps it in perspective, right? In 2018-19, our carryout went from 438, it almost doubled all the way to it doubled all the way to 900 million. Then last year we cut it back almost in half, and now this year we're going to cut it again. So the soybean carryout number continues to work itself lower. And a lot of that is because of acreage and yield, and a big piece of this is exports. So if you look across here, you have exports rising to over 2 billion bushels, which clearly means that they think that somebody's going to buy them, most likely China. So that's built in. But if you look at this, this is what's really mystifying about this report, okay? Is that we have a farm price of $8.20 forecasted by the USDA, which is 30 cents lower than the prior 2 years, with a carryout that's the lowest of the three. That is a head scratcher. I have no idea what that means. So something else is out there, and that's gotta. I think something's got to give here. So maybe they believe that this acreage number is too low, and that we're actually going to have a higher carryout than what this is. We just don't know, and this is kind of the problem in this business, is that we have nothing to trade off of except for what's in these reports. So as the reports start to move over and we get into June, July, August, September, these numbers will materialize and change. So today, if you just look at this number at 400 million carryout relative to where we're currently trading, you can make a good argument that soybeans are in fact undervalued. But let's look at this one. Here's your corn balance sheet, and I know everyone's talking about it. They put out a 3.3 billion bushel corn carryout yesterday with massive acreage numbers, big yield numbers. And so here's what I was hoping to be able to tell you, is that this corn carryout is because we planted a ton of acres, we yielded it, and we had crappy demand. But unfortunately, I can't tell you that, because if we look across the demand numbers, okay? So here's your big one. Here's your ethanol and byproducts number. They're forecasting use for this year of 4.9 billion bushels of corn used in ethanol, which is a reduction from the prior year. So this is the COVID problem, right? Look across. They're forecasting almost full run rate for ethanol grind moving forward. So they're using an optimistic or a normal number. I'd feel a lot better about this carryout if this number had a low 4 or even a 3 in front of it. But then, okay, so maybe they cut somewhere else, like in feed and residual. Well, here's feed and residual. Nope, they didn't. They increased it. So we're going to feed more too, to the highest level that we fed in the past 5 years. Okay, so they don't have any exports, right? No, they increased exports by 10 million metric tons, or by 375 million bushels. So unfortunately, the USDA, in order to get this carryout to a 3.3, had to use the high end of ethanol, feed, and exports, which to me is really nerve-wracking. Now, So what's the bullish case? Well, the bullish case is maybe this number here is too high, right? Maybe it's a 94, and we're going to look at that here in just a second about what that really does. But first, I want to put this into context for you because context is helpful. All right, so here is your corn ending stocks plotted on graphs from 2004 all the way through this year. This is really simple. Here's where we're starting relative to any prior year over the last 16. It does not take a rocket scientist to figure out that that's an outlier, and something has to happen to crash this number down into a normal range in order to prevent prices from deteriorating further. Well, here's another perspective thing. And I didn't come up with these charts. These charts got this one off of Twitter from Karen Braun. She posts excellent stuff. Here is straight off of K-State's Ag Manager. If you divide the corn ending stocks divided by the usage, you come up with a percentage of 22.4%. So put this in perspective. Here's last year's. Here's where they're projecting it to be. The only time we've been this low in the last 30 years is back in 1992. This is the last time we had a stocks to usage as high as it is, and the last time we had a carry out this big was actually back here in the late 80s. So we're forecasted to radically change this corn balance sheet, and it can actually get worse. Now, here's the bullish thing that's out there. For anybody that is really interested, is that this one keeps lowering. This arrow is right below this line here on soybeans. We're forecasting a stocks to usage of under 10%, which would typically result in significantly higher prices, $1.50 higher if that was going to be trading normally. But if this soybean market doesn't react to that number, then I think it tells us that something else is driving it. And it tells us probably that this number may be less realistic than the other. So this is why you have a kind of a bullish report to the price action yesterday. All right, so I want to show you this spreadsheet because I want to show you the what if scenarios. All right. So here's your WASDE report. Here's the May report taken straight out of it, and here is the same report copied right into the middle. Okay. So here we can hold acres, increase yield, but decrease demand to get a bearish case on what would happen to our carryout. And then on the right, we have a bullish case that we can play with and see, hey, what happens if we don't plant the acreage, right? Well, if we don't plant the acres, we drop, let's say we lose 3 million acres to beans, and let's say we get into some sort of harvest issues, and we actually harvest 4 million less acres than what the USDA is saying. And let's say we have some yield issues, so we don't yield trend line. We actually have a 172. And let's say that they continue to shrink the beginning stocks from last year and shrink last year's crop lower. So see what we've done? We've cut out acres, we've cut out yield, we've cut out beginning stocks. And let's just hold demand the same because they're already optimistic. If you do all those things, the best we get is just about 2 billion bushels, which is higher than what we've had this year. So the optimistic case isn't really that fantastic when you start with that big number of corn. Can it get worse? Absolutely it can. If we yield better, if beginning stocks were to grow, what if China doesn't buy, or ethanol doesn't recover, or we don't feed as much as we've ever fed before? All of those things increase the corn carryout and could pressure prices further. Well, so what about soybeans? Here's the exact same scenario for soybeans, okay? Here's your neutral case, here's your bearish case, and here's your bullish case. If we move acreage, let's say we move half of what we lost in corn to beans. Let's say we just move half of it and hold everything else pretty constant. But let's But let's say China only buys 200 million less than they said that they would. Well, now we have a big burdensome bean stock again versus here, right? Where on the other hand, if for some reason we harvest less or we get into some other issues, we can get real tight real quick. So beans have a recipe for an awful lot of volatility, while corn really does not. Okay, let's look at our charts. What does this mean? So I'm going to start with corn. If you do the homework here, and I take corn, let me get back to this chart, and let's go to the weekly. Let's do monthly. If we come all the way back to monthly corn chart and go back to the perspective of where those prior carryouts were, okay? Here's your 1992. So the last time the stocks to use ratio was above 22%, like we're talking, that was back here. And the price of corn had a range of 266 down to 203. So if that's the case, and that's where it was, then that's where that targets to. Again, this is just me putting a dot on a chart saying this is where the price was the last time we had a stocks to usage ratio at this level. I know I'm not surprising anybody by that number because it's been all over the news. Now, in the short term, though, we have a weather market and some things can happen. So let's take a step back and let's look at the daily chart so we can analyze that price movement. Let's scroll this back out here so we get a better perspective. Okay, we've been talking about this 13 and this 5s for some time, saying, hey, this is probably a floor, right? This is probably where the market should start to find some buying. And unfortunately, we just haven't triggered any real short covering. Yesterday was a big outside day up, which surprised the market. So you have a bearish report with a slightly bullish reaction to it, which if it follows through to this and can break today's or yesterday's high and get above 325, that could really ignite a short covering rally and give us an opportunity to sell this thing just a little bit higher, if that were to materialize. But given the fundamentals that we just went through, I really don't know what in the world would cause it. Maybe the acres are way lower and we're going to lose, 3, 4, 5, 8 million acres to some other crops. But we don't know that yet. So I don't think anybody's going to rush in and buy it on the hopes that the USDA changes that. Put that in perspective. That's the equivalent of saying last August of saying the USDA is going to lower the crop size and the yield because of the planting delays. We kept saying that, we kept thinking it, we kept trading off of that theory, and the USDA just never did it. So I think it's imprudent to believe that they're going to radically change the acres until they actually do it. So I think the bias is that if we do get some sort of a short covering rally, that we end up with an opportunity to sell it. Now, I have this oval up here because, and again, I have no idea when this will happen. I'm just putting this up here for perspective. This oval represents 38.2% to 68% retracement of the move from last summer to this low. That's what this oval represents. That's the bottom of it. That's the top of it. So if the corn market were to rally and retrace 38% of its prior move, that would put us into the bottom end of this circle, which is about 350 old crop. Let me go to new crop here. Here's the same circle. That would put you at 360 old new crop, maybe 365, 370 if we're lucky. And you can see where that is, right? Here's some resistance, here's some support. Again, I think that is a long shot given that report, but anything can happen, and it would not surprise me a bit to see that some follow through to this and to see some upside potential. Now, here's the problem. is that I've got to scroll this chart way back in order to get um, uh, this 240 level even onto the chart. So you could see a small rally, and then you could see a grind or a complete price collapse if in fact that's what the fundamentals end up being. Um, I have no idea if this corn carryout is going to be 3.3 billion, 4.6 billion, or 2 billion. I have no idea. But the reality is, as farmers, the risk is lower. Um, even though we have 13s and we have three and we have wave counts and we have bullish divergences, those fundamentals are terrible. So the downside risk is palpable, and it is very, very real at this point. So we need to be looking at options that allow us to set floors and remove some downside risk in our cash positions. So one thing I want to go over real quick is an accumulator that is pretty attractive. Now, what an accumulator is an opportunity that combines price and time without posting any margins. So what you can do is set a floor at 330 on your corn. Okay, so I'm going to mark that with a horizontal line here. We can set a floor at 330, and then every day that the December corn contract trades above 330 from now until November, we can get an accumulator that will price your corn at 370, which is up here. So somebody is willing to let you price your corn at 370 every day that the market is above 330 with a floor of 330. And what happens if the price moves above here and we go crazy? Well, your price is open. You're not pricing any bushels above 370. It's hard to beat that because there's no cost to it. You're not putting out money for a ton of put premium. You're not taking on margin exposure. You're not taking on any of that risk, and it allows you to price at the upper end of this band. And remember, this is a 62% retracement of the entire move, of this last entire move. So you're obligated to deliver the bushels, but in this situation, you get to choose your destination, and you get to set your basis on your own. So you get all of the flexibility that you want, and you get the opportunity to significantly reduce your downside risk. So to me, that makes an awful lot of sense, or just getting some puts put on here to hedge that risk, because we don't want to let that go. If you're able to price bushels in this area and set a floor, and we do price down into here, the crop insurance, the PLC, the government payments, coupled with cash sales that are made, it's going to turn out to be a very lucrative year for farmers if you take all that action. But if we stick our head in the sand and say and disbelieve it, then we won't get near the benefit out of it that we previously thought we had. So, I was definitely hoping that we would see acres a lot lower, and maybe we still will, but we can't bet on that until it's real. One last thing on soybeans. I've been bullish soybeans for a long time. This chart is definitely turning more and more bullish every day, until yesterday, when we were unable to break out and break through 861. And on a bullish report, we didn't rally on soybeans. So soybeans continue to be the dog that didn't bark, where we get bullish news and we don't go up. So something is going on in soybeans, because we should be working higher. I mean, with our stocks to use, we should be up into this range right in here on soybeans. So I can see it coming all the way up to here, and I can see it following corn down as well, if for some reason our carryout is going to grow significantly. So there is risk in beans, both directions. And I hate to be that ambiguous about it, but something's not making sense with where beans are trading relative to that carryout number. So stay tuned, and we'll see what happens with them. But at the moment, if your price risk is down and you're planting more acres because they pencil out better than corn, then you need to reduce that downside risk and keep your upside open, because the market can take away any um, extra profit or extra incentive that it had, especially if corn is going to start to work lower. All right, that's 20 minutes. Lots of stuff. If you have any questions or have an interest in that accumulator, just holler at me, and we'll talk through it, and we'll catch you next week. Have a great day.